Most people see banks as, dull, necessary places. They are where we deposit our paychecks. They are where we go to get cash from a machine. We think of them as simple storage boxes for our money, paying a tiny bit of interest for the privilege of holding it. This view is common. It is also incomplete. It misses the true nature of what a bank is and what it does in our world. This limited perspective can hold us back from achieving our most important financial goals. This view is far too small. Banks are not just passive boxes that hold money. Banks are powerful engines. They are the circulatory system of our economy. They actively move money from where it sits to where it can be used to create something new. They are the institutions that decide who receives the capital to buy a home. They help build our cities. They fund new jobs. They shape the opportunities available to every single one of us. They are not boring. They are the architects of our financial landscape. Think about the most significant milestones in a person's life. Buying a first home is a dream for many. Starting a small business takes courage and capital. Saving enough money for a comfortable retirement is a lifelong journey. Getting a loan to pursue higher education can unlock a new career path. All of these major life events pass through the banking system. Banks operate quietly behind the scenes, yet their decisions have a profound impact. They determine how easy or difficult these steps will be for you. This is not a story about blame. It is a story about understanding power and learning how to use it. Banks are much more than just places to store your cash. They are vast and powerful data engines. Every single transaction you make, every dollar you move, tells a story about you. The bank sees your financial habits with perfect clarity. It sees how you get paid, whether your income is steady or unpredictable. It sees how you spend your money, what you buy, and where you shop. The bank learns if you are a saver or a spender, if you consistently pay your bills on time, if you maintain a stable balance in your account over a long period. From the bank's perspective, you are not just a customer with a name and a face. You are a living financial record. This record, this data story, shows the bank whether you represent a steady and reliable partner or a risky and unpredictable one. A person with a steady, predictable record will almost always get better loan terms. Have you ever wondered why two people earning the exact same income can have vastly different experiences with a bank? One person might be effortlessly approved for a mortgage on their dream home, while the other struggles to get a simple car loan. This isn't a matter of luck or favoritism. It's a calculated decision rooted in one of the most fundamental principles of banking. What banks value above all else is predictability. At its core, a bank is a business that manages risk. They take in deposits from customers and lend that money out to others, earning a profit on the interest rate spread. Their entire business model hinges on their ability to accurately predict who will pay back their loans and who won't. Predictability isn't just a preference for them, it's the bedrock of their stability and profitability. When a bank evaluates you, they are not just looking at a snapshot of your finances today. They are reading a story you've been writing for years through your financial actions. Every transaction, every payment, every deposit becomes a data point in their risk assessment model. An unpredictable customer is a high-risk customer, and risk is something banks are paid to minimize. So, what does this prized predictability look like in practice? First, banks like to see a steady income stream that arrives like clockwork. A consistent salary from a long-term employer is the gold standard because it suggests stability and a reliable ability to meet future obligations. This doesn't mean freelancers or business owners are excluded, but they must work harder to demonstrate that same level of income consistency over a longer period, often 2 years or more. Second, they look for a long and unblemished history of responsible financial behavior. This means paying your bills on time, every single time. A consistent record of on-time payments for credit cards, student loans, and mortgages tells the bank you are reliable. A single late payment can disrupt this narrative, signaling potential instability. They also like to see this history with one or more financial institutions, as it shows you can manage relationships across the financial system. These things, a steady income and a flawless payment history, build a foundation of trust between you and the bank. This trust is not just a vague feeling, it is a tangible, quantifiable asset. It's the currency of the financial world. When a bank trusts you, they see you as a low-risk partner. And this is where you gain leverage. That trust directly translates into powerful financial advantages. For those who have proven their predictability, the doors to opportunity swing wide open. They will be offered lower interest rates on everything from credit cards to mortgages. Over the life of a 30-year mortgage, even a fraction of a percentage point saved can mean tens of thousands of dollars. They will also be granted access to larger amounts of credit. This isn't just about having a higher credit card limit, it's about having the capital available to seize opportunities. To start a business, invest in real estate, or navigate an unexpected emergency without derailing your financial life. Trust gives you access to the capital you need to achieve your goals. This is the simple, unvarnished truth of modern banking. It's a system built on rules, and understanding those rules is the first step to making them work for you. Your daily financial actions are writing a story that the bank reads every day. Each on-time payment is a well-written sentence. Each month of stable income is a compelling chapter. If you want to use this system to your advantage, you must become a conscious author of that story. This means moving from passive participation to active management of your financial narrative. You need to understand precisely what the bank is looking for and intentionally build a record that demonstrates three key qualities. First, stability. Show them you are a fixture, not a fleeting risk. This is reflected in your employment history, your residence, and the consistency of your income. Second, responsibility. Prove that you honor your commitments. This is where your payment history is paramount. Automate your bill payments to ensure you are never late. Keep your credit utilization low. Treat every financial promise, no matter how small, as a binding contract. And finally, trustworthiness. This is the culmination of the other two. It is the reputation you build over time. By consciously curating a history of stability and responsibility, you create an undeniable record of your trustworthiness, turning the bank from a gatekeeper into a powerful partner on your financial journey. When you deposit your money into a savings or checking account, it's natural to picture it being carefully set aside, waiting for your return. You might imagine a personal safe deposit box or a specific corner of a vast vault, earmarked just for you. But in the modern financial system, your money does not simply sit in a vault with your name on it. In fact, for it to do so would be a disservice to you and to the economy as a whole. Money that sits idle loses its power, its potential eroded by the slow, steady march of inflation. Your money does not take a rest. The moment your deposit is recorded, it joins a vast, dynamic river of capital. Instead of being a static object, it becomes a vital raw material for the bank, a resource to be actively managed and deployed. The bank pools your deposit with the deposits of thousands, sometimes millions of other customers. This process, known as aggregation, transforms countless small streams of individual savings into a formidable reservoir of capital. This isn't just about piling up physical cash. It's a sophisticated digital ledger, a massive interconnected database representing the collective financial trust of a community. The bank then uses this large pool of capital to lend out to other people and businesses. This is the fundamental business of banking, a process known as capital allocation. It is arguably one of the most important functions a financial institution performs, acting as the heart of the economy, pumping lifeblood into the places where it's needed most. Think of the bank as a critical intermediary. On one side, you have savers, individuals and businesses who need a safe place to store their funds and earn a modest return. On the other side, you have borrowers, entrepreneurs, families, and corporations who have productive ideas but lack the necessary capital to bring them to life. The bank stands in the middle, bridging this gap. It funnels this collective capital toward projects and individuals that it believes are most likely to succeed and, crucially, repay their loans with interest. This decision-making process is the allocation in capital allocation. It's a discipline of risk assessment, economic forecasting, and deep community knowledge. The bank's experts analyze business plans, credit histories, and market trends to make calculated decisions about where the community's savings should be directed. So, What does this look like in the real world? Your savings might become part of a mortgage that helps a young family buy their first home. This doesn't just provide shelter, it creates stability, builds generational wealth, and fuels the real estate and construction industries. That single loan ripples outwards, creating jobs for agents, inspectors, and contractors. Or consider a loan to a small manufacturing business looking to expand its operations. With that capital, the owner can purchase more advanced equipment, increasing their output and efficiency. To run the new machinery, they hire more workers from the local community, reducing unemployment and increasing household incomes. Those new employees then spend their wages at other local businesses, creating a virtuous cycle of economic activity. The bank's capital might also fund a student loan, enabling a promising individual to pursue higher education they couldn't otherwise afford. This is an investment in human potential, one that can lead to innovation, skilled leadership, and a more capable workforce for decades to come. This constant, carefully directed flow of money is what helps our economy grow and thrive. It transforms passive savings into active investments. It turns the potential of an idea into the reality of a new business, a new home, or a new career. By participating in the banking system, you are doing more than just storing your wealth. You are providing the fuel for the engine of commerce and community development. Your deposit, combined with millions of others, becomes a powerful force for progress. One of the most powerful and often misunderstood concepts in banking is the idea that banks create credit. When a bank approves a loan, it does not always have to use the physical cash that you and others have deposited. Through the mechanisms of the modern financial system, the bank can essentially create a new digital balance for the borrower. When the bank makes a loan for a home, it credits the seller's account with the loan amount. This new balance functions as new money within the economy, allowing for transactions to occur that would not have been possible otherwise. This ability to create credit is the fuel that powers much of modern life. It helps people achieve major goals much sooner than if they had to save up the full amount in cash. Without this system of credit creation, our economy would move at a much slower pace. However, credit is a powerful tool that can also cause harm if it is not managed responsibly. That's the difference between debt and leverage. At its core, a bank is a business that manages risk. Before a bank lends you money, it must ask a fundamental question: what is the probability that we will get this money back, with interest? The bank is not making a personal judgment about your character. It is making a calculated business decision based on data. To do this, it uses a few simple but powerful metrics to assess the level of risk associated with each potential borrower. One of the most important numbers is your credit score. This 3-digit number is a summary of your history of borrowing and repaying money. Another key metric is your debt-to-income ratio. It wants to see a consistent and reliable pattern of paying your bills on time, every single month. For many, the word debt triggers a sense of anxiety. It's often seen as a burden, a financial trap to be avoided at all costs. We're taught to fear it, to pay it down as quickly as possible, and to celebrate being debt-free. But what if this is only half the story? What if debt, when viewed through a different lens, isn't a trap at all, but one of the most powerful tools available for building wealth? Once you understand that banks are not just vaults for your savings, but complex engines for managing capital and risk, your entire financial perspective can shift. You can then begin to think about how to use them strategically, specifically for something called leverage. So what is leverage? In simple terms, leverage is the ability to use borrowed money, often referred to as other people's money or OPM, to increase the potential return of an investment. It allows you to control a large, valuable asset with a relatively small amount of your own capital. Think of it like using a lever to lift a heavy object you couldn't possibly move on your own. Your strength is amplified. In finance, your capital is amplified. This requires a fundamental mindset shift. A smart borrower does not just think about what they can buy with a loan. That's a consumer mindset, which often leads to high-interest debt for depreciating assets like cars or electronics. An investor, however, thinks differently. They think about how that loan can be used as a tool to acquire an asset that will generate more wealth or opportunity in the long run. They ask, will this debt pay for itself and then some? Let's explore the most common example of leverage in action: the purchase of a home. When you take out a mortgage, you are using leverage. Imagine you want to buy a home valued at $500,000. Saving that entire amount could take decades, but with a mortgage, you might put down 20%, $100,000, and the bank provides the other 80%, which is $400,000. You now control a $500,000 asset, even though you only used $100,000 of your own money. Now, let's see where the power of leverage kicks in. A few years later, the housing market has been strong, and the value of that home increases by 10%. The house is now worth $550,000, a $50,000 gain. Did you make a 10% return? No. Your return on your initial investment is much, much higher. You made $50,000 on your $100,000 investment. That's a 50% return, not 10%. You benefited from the appreciation of the entire asset, not just your portion. This is a classic, powerful example of using the bank's capital to amplify your own. The same principle applies to entrepreneurship. A small business owner might take out a loan to purchase new equipment that increases their production capacity. The increased revenue from that new equipment is designed to pay off the loan interest and principal, with the rest becoming pure profit. The loan isn't just a debt. It is a strategic tool for growth and wealth creation. But it's crucial to acknowledge the other side of this coin. Leverage is a double-edged sword. Just as it amplifies gains, it also amplifies losses. If the value of that $500,000 home had decreased by 10%, it would now be worth $450,000. Your initial $100,000 equity would be cut in half to just $50,000, a 50% loss on your investment. You still owe the bank the original amount you borrowed, regardless of the asset's current value. This is why using leverage responsibly is paramount. It's not about borrowing as much as you possibly can. It's about calculated risk. It requires thorough research, a clear understanding of the asset you're acquiring, and a solid plan for managing the debt, even in a downturn. So, if you want to use banks effectively, you must learn to adopt this strategic mindset. Stop asking, "How much can I borrow?" Instead, ask yourself a series of more powerful questions. How will this loan serve my long-term financial goals? Does this debt acquire an asset that will grow in value or generate cash flow? And most importantly, have I accounted for the risks, and do I have a plan to manage them? By answering these, you transform debt from a source of fear into a sophisticated instrument for building your future. Beyond their role in allocating capital, creating credit, they protect your money. In a world filled with uncertainty and risk, a trusted bank acts as a guardian for your wealth. In many countries, one of the most important forms of protection is deposit insurance. In the United States, for example, the Federal Deposit Insurance Corporation, the FDIC, insures deposits up to a certain amount, typically $250,000 per depositor per insured bank. This means that if your bank were to fail, your savings are protected by the full faith and credit of the government. Banks also invest heavily in systems designed to detect fraud and teams of experts to monitor transactions for suspicious activity. The world of finance is changing at a breathtaking pace. Financial technology, or fintech, companies have created apps that let people transfer funds, invest, get loans, all from a smartphone. Automation and artificial intelligence are helping banks analyze loan applications faster and more accurately than ever. New forms of digital assets and currencies are challenging traditional financial systems. Banks aren't standing still. They're adopting new tools and integrating them into operations, launching mobile apps, improving online services. But tools change. Core principles stay the same. Banks allocate capital, manage risk, and balance growth with security and stability. So, how do you put all of this knowledge into practice? It begins with a series of simple, deliberate actions. Ensure your primary income is directly deposited into the same bank account on a regular, predictable schedule. Use that account to pay your major bills automatically and on time. Open a savings account and make regular automatic contributions, even if the amount is small. Know your numbers, learn your credit score, review your report, and calculate your debt-to-income ratio. When you borrow, plan for long-term advantage. Ask questions. Treat the bank as a partner, not an adversary. The system already exists. Will it work against you or for you? The choice is yours. Learn the rules. Use the tools. Build your future. If you want more deep dives and tools for long-term wealth, subscribe and check the description for resources.